Hello and welcome everyone. My name is Shane Swanson. I'm a senior analyst with Greenwich Associates in the Market Structure and Technology Group. Today I'd like to welcome Jim Toes, the President and CEO of the Security Traders Association, or STA. Today we're going to have a lively discussion around the STA's decision on moving their annual Market Structure Conference from a live event to a virtual event, as well as a discussion around a number of hot market structure topics, or at least as hot as they get in this day and age. So with that, welcome, Jim. Thank you very much for participating today, and let's get right into it. First of all, obviously, the STA has been a part of our industry for quite some time now. I think you mentioned it was founded in 1934, right after the SEC itself was founded. And we've had a market structure or an annual conference this is the, how many annual conferences have we had?
A lot of them. Yeah, I don't know the exact number, but we've had
86 or 87 now in a row. So the 2020 Market Structure Conference was going to be in DC, as we have had for the past number of years. Why don't you talk to us a bit about what the event was going to be, what the event is going to be, and kind of how we got to where we are today?
Sure. I mean, yeah. So first of all, thanks for having us on today to give us an opportunity to talk about the conference and also some of these issues that we're going to be addressing today. Listen, I mean, we've always had this. We've had this conference for a long time, but historically it used to be held like in a resort type setting, and around 10 years ago, there was a decision was made by the board to kind of move the big event to DC. And we had to somewhat start all over again as far as bringing in the audience, but that decision really has paid tremendous dividends for us. As seen by last year, we had record attendance last year. Come to the event, so it's a pretty diverse group that normally attends. Having in DC, obviously, we're able to get more of the regulators to come, staff members at the various congressional committees, and it's also just a lot easier, obviously, for an employee to go to their boss and say, I'm going to a conference in DC versus Boca, right? So that decision has paid off. Obviously, we're really bummed that we're not going to be able to have it this year in person in DC. But, because people obviously place a tremendous value on the networking aspect and just being around each other. But, given the events of COVID-19 and the restrictions on travel and work at home, we really had no choice but then to go virtual on it. So we're in a much better spot now. I mean, the virtual thing, I don't know, folks, if you're looking to do events, I mean, obviously it's the virtual platforms that are out there are, more robust and offer a lot more features than just a classic Zoom webinar or Zoom meeting. But we've kind of passed that hurdle where once we kind of found the platform that we're going to be using for it, we're starting to realize the benefits of it. Some of the more obvious ones, obviously, are our ability to attract speakers who are normally restricted by the travel. It's going to be a very good program again this year. We're not bumping into that challenge that we've had historically. Obviously, we're going to be able to reach a much broader audience than we've had in the past. And then the other one, too, is just the whole recording feature, that our ability to record these events really allows people to kind of consume the content when they want to do it. So we're pretty excited about it.
That's great. And you mentioned, obviously, the ability to attract speakers. So who would you say were some of the highlight speakers you are able to bring into the conference this year?
Well, this year, listen, we always try to touch a lot of bases, right? So on the congressional side, we do have Congressman Heisinger locked in. He's the ranking member on the House Financial Services Committee, so he'll be speaking on Wednesday. We do have, Commissioner Elad Rossman from the SEC. We have Commissioner Dawn Stumps from the CFTC. We have Robert Cook from FINRA. So we kind of cover all those bases on it. And then we start getting into the business area. So, for us, when we look at the program, we have this fundamental belief that our markets are highly interconnected with each other. The ability for capital to move from options to equities, ETFs, and almost more so futures, and now getting more into fixed income, that our events tend to be pretty diverse. So our participants, our average participant tends to go to 2 conferences a year. They go to the one conference that is dedicated just to their business, and then they go to ours, right? So if you're in options, you're going to OICs, but then that you also come into ours because you get a little bit of options, you get the DC element, and so on. So some of the speakers that we have, which obviously are relevant to some of the topics we're going to touch on today, we do have Dan Gallagher, a former SEC commissioner who is now the chief legal officer for Robinhood. We do have Ed Tilley and Brian Harkins from CBUG talking, and obviously we have John Kellner from MEMEX. So those are all topics that we're going to be touching on, in addition to Brett Redfern as well, who will be presenting on the Wednesday portion of the conference.
That's fabulous. And again, I do think it's interesting that in today's environment, as difficult as it is to make a decision to switch from live to virtual, you do have that ability now to kind of free up the ability to get people to speak, right? Whereas, I know in conferences past, there's always that element of, well, we think we've got these people and we think they're going to show up, but at the very last minute, they may get called to another meeting and then they have to have somebody else show up. So I do think we are, in some ways, you'll have a higher certainty of the people who are to speak being able to make it, because they'll be able to do it from their office or from wherever they're at, from their home location at least. So I think that's all to the good in that level. Let's pivot, I think, a bit then, since we mentioned some of these speakers and these topics, with Robinhood, with Kellner, with MX. There is a lot of interest today. In particular, we've seen this increase in retail trading. There's a lot of discussion around retail trading. It's difficult to get explicit metrics around the volume of retail trading. I believe everyone would agree that retail trading has increased. There's very little, very little to say that it hasn't, but to get to the exact number of that is very difficult. We've all heard it bandied about what is the Robinhood effect, where are stocks going and why are they being driven as they're being driven, and is it retail only that's causing that? So what are you hearing about that, and what are the hot topics in retail today?
Yeah, so I do think that, just to address the metric point, you are right. It is hard to find retail orders that are specifically go into, we call them self-directed retail investors, the retail investor who is at home, not using an advisor, having a platform, engaging the marketplace themselves, directly. So it is hard to kind of track that person's behavior in the equity marketplace, because all orders are getting sliced up into 100-share lots, right? No matter who the investor is, small, medium, or large. However, in the options space, I do think there are some metrics out there that are showing the average size of trades, or contracts that are trading in options, that really do give a strong indication that, while self-directed retail investing is not a new investor class to be trading in our marketplace, there are definitely new players who were not buying and selling stocks 7 months ago that are buying and selling stocks and options today, that are obviously coming in, through a Robinhood platform. So, the Robinhood effect that does get a lot of attention around, and I think I probably share a lot of the same feelings that folks on this call do. It's on the one hand, like, it's very exciting, right? It's great to see this level of engagement by these types of investors. It's great that our marketplace was able to facilitate these investors coming in. We were not the only country that went through COVID-19, but yet, this seems like the ability for investors to, get on an app, open an account, start trading, getting the information that they need to trade is pretty impressive, right? And this is like, these are positives, but obviously, listen, I'm concerned, right? I mean, I'm not a day trader, right? Even though I did trade stocks for a long time at my previous employer, I really don't like to see. I wouldn't want my college age kid and 20-year-old kids, day trading as a way to make a living, or trying to save for retirement, and there are concerns around that. But I don't know. Right now it's like I don't really know how they can be protected per se, but we'll just have to kind of try to make the most of it.
Yeah, and I do think from an industry perspective, probably one of the biggest challenges is we want the engagement. We want more people to be in the industry, in trading. We want investment, but we want it done with the appropriate knowledge. We want it done with the appropriate education. And when you do have such a massive influx in such a short period of time, and again, just following trends, at least until Robintrack stopped providing it, you saw some of the investment decisions that were being made that didn't necessarily seem to track what the fundamentals or long-term focus, right? And it did feel a little bit more like gambling. And if somebody does that with, forethought, right? Hey, I have $100 and I'm willing to gamble it, and I don't have sports to watch, or I'm not in the office or whatever, and they do that knowingly, okay, that seems fine. But if it's somebody who is, taking their college fund or their retirement monies and thinking that it's a get rich quick scheme, that's where I guess the industry, concern arises, I believe, and the educational component needs to come back to the forefront, at least that in my worldview.
Yeah. I mean, listen, the education is, I mean, I think the SEC, their website has really, during this COVID experience that we've all been going through, I do find myself going to the SEC's website more now than I have in the past. And the information that they have out there, the alerts, the investor alerts, and on just for investors is pretty impressive on it. And probably the one area where maybe we want to just kind of jump into it is the topic of payment for order flow, right? So this obviously this is obviously a very hot topic. We have there are new disclosure rules that were put in place where we're getting the numbers on a monthly basis. So we're getting them more frequently now. So our ability to have transparency into how much is being paid to particular firms from payment for order flow is out there right now. And this is like a really odd topic. It comes up a lot in our conversations at the SEC, and I'm just going to kind of just walk through like how these conversations tend to go. So first, it starts out with just a personal experience that I kind of had with payment for order flow. So, I was at Merrill Lynch for a while trading over there. We did not service these, the discount brokers. We did not service those types of accounts. We kind of had the institutional and our own retail on it. And then Merrill Lynch acquired Herzog, right? And Herzog, obviously, this was their bread and butter. And Herzog did pay for the order flow. And the part that really was just took me a while to kind of get my head wrapped around was, I could never understand how I was paying someone for something, but yet they were still the customer, because you had to pay and provide an enormous amount of service to that client, because if you didn't, there was someone else willing to pay and service them away from you. So it was so counterintuitive to who's a client in this relationship and who's not on it. So, but listen, I get it. Like, the dollar amounts are shocking that we're looking at. And when we look at the dollar amounts, the conversations around conflicts of interest obviously start to kick up here. And I don't think anyone disputes that there is not a conflict of interest, between the two parties on the payment and the selling of the order flow. But just to kind of give you a sense of how regulators kind of look at conflicts, when they look at it, the first thing they kind of ask is the conflict being disclosed? Okay, which it clearly is, as we're getting in these reports. The second thing is there a way to measure whether the conflicted party, that being the broker-dealer who's selling the order flow, is there a way to find out if they are behaving in a way that's purely driven by the payment? And I do think that is disclosed as well, as far as these firms who are selling the order flow. They are saying where they are going with the orders on it, from a best X perspective. The third one is, do investors have other choices, right? If I'm dealing, I know this is really hard for regulators to get their head wrapped around, again, but it's like sometimes we know we're dealing with a conflicted party and we still do it. So, these investors have other choices. They don't have to go to one PD. They can go the other places. And then the last one, and this is where I think where the SEC and kind of pauses as when they look at taking their approach to the payment for order flow, is that the fourth question they tend to ask themselves is that, would the investor be better off if we just removed the conflict, if we just banned it? And I think when they look at that, if they were to put in some hard, blunt rules saying we are not going to allow, payment for order flow to exist anymore, I don't think they're comfortable with what the regime would look like for these investors who are trading today.
And I think that's fair. And again, similar personal experience when I was with Automated Trading Desk, and we dealt with the same issues where, yes, we were paying for order flow, but we also had incredibly fierce competition for those clients. And when you are in the realm, it's easy to see how easy for a broker that, yes, pitch you against someone else, and they pitch you on all metrics, right? It's not, okay, who pays the most is the only determinant. It's also, where do I get the best execution? And you fight fiercely with your competitors, to the end benefit of the retail client, to, lesser or greater extent. And so I think you're right. The striking, component there would be, if you just got rid of it entirely, how would that change the dynamic for the end retail investor, and what would be the spill-on effects? Would the retail investor lose access to capabilities that are basically paid for by that payment for order flow that they wouldn't otherwise have access to? I have other research which shows the retail investor has tools that are on par with what a lot of institutional investors have, and the fact is, the only reason they have access to those tools is the brokers have funds that are allowed to subsidize those tools that they provide to the retail investor. Without that funding, does all that funding go to the retail investor? No, some of it goes to the broker. But again, if you're getting a free execution from the broker is not doing that out of the goodness of their heart. They're getting paid somewhere.
No, that is true. There is no such thing as a free ride anywhere, right?
Right. And what about the other question, which we seem to see in the press a lot on, is retail trading what is actually driving what's going on in the larger market as a whole? Is retail what is making the bull market run?
Yeah, I mean, that's a hard one, right? That's a hard one to. I'm sure that again, we'd have to kind of go back to maybe look at where maybe some of the single stock options, because I think that's where some of the, again going back to the metrics on this. If you kind of look at some of the more active issues in options, they tended to be more in like the products, the SPYs and index type of products, options on those types of products. And now you're seeing like a flip-flop where the notional value on individual options is actually for the first time getting up, maybe even on certain days passing the notional value on these the indices types products. And I think that is a very clear, again, that's a very clear indicator that I don't think that the people at home who are day trading through these types of accounts are necessarily buying and selling an ETF. They're looking for something that has a little bit more exciting story around and so on. So I do think if you're looking to see the impact, obviously that activity in the options will obviously spill into the equities. So yeah, I mean, I don't think you can dispute that they are having, an impact on some of these more high-profile names that we read about in the paper all the time.
And I would agree. I do think there's without a doubt a retail impact in individual names, and that's indisputable, right? You see the impact. It's touted on a bulletin board, and the retail investors pile in, and stocks move up or move down. I guess the broader question, the one that I don't know that there is still an answer to, although I know there's been research done and with varying answers as to whether or not they're actually the underpinning of the overall market cycle or not. My personal view tends to be their individual movement and individual names, but the underlying structure of the marketplace is still more institutionally driven.
Yeah, I mean, I would say, this with most institutions, while they do tend to come in to, cross the spread, they do try to let the stock kind of go where it wants to go, and then come in and then do their trade. They don't want to be impacting the price of the stock. So yeah, so to a large degree, the retail person is probably less, has less discretion around that, and they're the ones who may be putting the stock at a certain price, whether it's there for a long time or temporarily or not, and then the institution kind of comes in with, with their orders on it, trying to be not as impactful in the price as the retail folks tend to be.
Switching topics a little bit and cognizant of time, one of the things that is also driving market structure right now is there's always choice. We're about to have a lot more choice in the equity market with the entrance of the 3 new equity exchanges in the next 30 days. I don't think we've ever seen 3 new equity exchanges go live in such a short period of time. So I'd like to get your thoughts. I think it's the LTSE starts their rollout on August 28th. MX goes live on September 4th, and MyX Pearl Equities goes on September 25th.
Yeah, September's going to be a busy month. So, Listen, a part of it is, there's a certain irony to it, because we do hear a lot of concerns being expressed around, off exchange trading and how that continues to hit new high levels, off exchange non-ATS volumes, continue to increase. But yet we continue to get new entrants into the marketplace, the new exchanges into the marketplace. And, listen, these are smart people that are starting these exchanges. I'm sure they see an area where they can compete and provide a service, and where they see some competitive advantages, where they can bring something different to the table. So competition is good, but it obviously it does put some stress on the brokers having to connect. But for now, it's happening, and we just have to find a way to kind of make the best of the situation and try to find out what unique offerings the exchanges have, and as a broker dealer or as an account, how can I recognize that material difference.
And what are your thoughts? I know that each of them has kind of, I guess, a different spin on how they're trying to bring in new business, right? So start at the latter and bring it back. Well, start at the first. So LTSE really is I'd call it a fundamental play, right? So they want to bring a different view of the market, long-term, investor focus, no quarterly reporting. You look at MX, and they're really, they have equity ownership from some very large players, and they're bringing, brand new technology to the forefront. And then you have MIAX Pearl Equities, which just announced pending SEC approval, kind of an equity jump ball program over a 40-some-odd month period, different tranches to get ownership of the holding company. So 3 very different models. How do you think of how those will interact?
Yeah, I mean, listen, the 3 models are different. I mean, obviously the first one, it looks like they're not going to, they're not building, their business model is not being built on transaction revenues, right? They're they think that they have a new way of providing listing standards that companies will find attractive, and they'll make their money that way. The second one, MEMX, I mean, obviously the owners who are shareholders in the entity are the ones who feel that it's just too expensive to trade on an exchange, and they felt that rather than trying to argue with it, they just decided to get in the game and try to find a way with new technology, as you pointed out, and a new fee structure around it. So I mean, listen, they're bringing something different to the table. I kind of wish there was something around a lot of this. Obviously, I mean, LTSE is probably not a good example around this, but I do wish that there was something around that was helping that middle third of securities trade a little bit better. I mean, I feel, we talk a lot about the secondary liquidity for thinly traded securities, right? And the top third of securities trade well no matter what exchange or platform they're kind of trading on. The bottom third is always going to have challenges with liquidity. But I think, in the time that we've been, at least in my time being in the business with it, that middle third, we really we need a solution for that middle third. Those size companies to that's not being satisfied or addressed with our current market structure.
And there have been a couple of proposals, right? So obviously there's been the proposal around suspension of unlisted trading privileges. CBOE's put out their new periodic auction filing, to allow for kind of an on-demand periodic auction at a millisecond timed frequency across all stocks, but you would assume that might find more traction in maybe some of the more thinly traded names. Do either of those, do you think, have traction in the industry? Where do you think that might help, or what other new ideas might there be around thinly traded names?
Well, I mean, the concept of obviously of auctions is something that is interesting, right? So, I won't comment on CBOE's specific auction filing, but in general, I mean, listen, there was auctions have been around for a while. There are some that exist today in the private market, with ATSs owned by broker dealers, and they perform a unique function. And as someone who used to trade these small and thinly traded names, they were really good for those types of securities, having those timed auctions during the day where liquidity had a chance to come into one place, the large orders, and had a chance to interface with minimal market impact. So there is a value that I think I and a lot of people see in auctions for thinly traded securities. Now, obviously, we're not the type of marketplace that takes something from the past, like the exact same thing, and then takes that exact same thing and drops it into the future. That doesn't really work. But what is the modernized version of auctions today? And can a modernized version of today's auction, fill that same need that was needed, that was the way it was done in the past? So we don't, we never like to, go back in time, right? Our market's always about going forward. So, I think auctions play a good role, for these types of securities. What auctions look like, in that space is going to be different than what they looked like in the past on it. And listen, I think that, when Congress told the SEC in 1975 to go out and build, a national market system, they did, one of the principal guidelines was, was competition between participants and among them. They wanted to create an environment where exchanges could compete with exchanges, but they could also compete with broker-dealers. And the same thing with broker-dealers, that there's competition, there's healthy competition between BDs, but they should also find ways for BDs to compete with exchanges with some functions on it. So listen, I think it's good, right? We like to see the exchanges be creative around this. Obviously, there's going to be a ton of complexity around trying to figure out, how this impacts the continuous quoting that we go on. The market, and I think the concerns around that is that we just feel like today's market structure, when you look at things like spread and speed of execution, like it's really good. It's really good. And if you touch anything, can you really improve that part? Or you bring in something that, okay, it makes this better, but then this part kind of goes like, spreads get wider. So I think that's kind of where I think some of the thought process around is going to go on auctions.
I think it's excellent. And going back to, as you said, all the way to 1975, the SEC is, not resting on its laurels necessarily even there. So we've had what's been called the Reg NMS 2.0 initiative by the SEC, which goes back and is now addressing some of those very underpinnings of the securities information processors, the SIPs. We just saw the approval of the order that now SIP NMS plans will no longer be effective on filing, so there will be a notice and comment period. That was kind of the first pillar of the 2.0. The next was the SIP governance order, so that's gone from a proposal to an order, and I think that's working its way through the SROs as they come up with their new model for governance. And the third pillar of that was the SIP infrastructure proposal. So that one, at least at my last look, was still in review. It had a bunch of comment letters, kind of all came due during the height of the crisis with Corona, or the COVID crisis. But nonetheless, I believe that is kind of in the works. We'll see where it comes out. I know several other press statements have come out from industry participants who are looking at the SIP and what maybe some modernization impacts might be to the SIP. What are your thoughts there? And I would say maybe even broader, what are your thoughts about what the SEC's near and longer term view might be, in particular with Chairman Clayton's term coming to an end here shortly?
Right. So this is the speed round part of the interview, right?
Sorry, I packed a lot into that.
Let's see on the governance land. A good. Okay. Why don't we kind of try to take them one at a time? The effective upon filing. Okay, so with eliminating that exemption that they were afforded on it. So listen, I think unfortunately it was of course it was a course of action that we think the SEC just had to take. All right. I think that some of the filings around pricing, price changes that were coming in, they were just some of the parts that had to be satisfied. The legal part, does this pose any threats to competition? They were kind of becoming a little bit of check your box type things and not being challenged to the degree that they should be. So there was a certain element of maybe a cavalierness in how they were being filled out. I'll use that word. Some people will use stronger words like abused and maybe even gamed by some. So it is. Yeah, I think the SEC that was they had to take that type of an action. Unfortunately, for exchanges are really limited in the areas where they can compete with each other, and I do have some where I feel, I don't want to use the word I feel bad about it, but I do kind of feel bad that like there's a big difference between an SEC rule filing and effective upon filing, of what they used to be. And yes, it's great that with the SEC rulemaking, yes, we'll get greater transparency and there'll be a lot more data for people, more time for people to make the comment on. But I do think that may have a negative impact on some of the smaller and mid-sized exchanges who maybe don't have the resources to kind of go through this whole process of an SEC rulemaking every time they want to make a price change on something. So I do have some reservations around it. But on the other hand, I don't think the SEC had any other course of action to take than what they did. As far as the governance one goes, that one's obviously is more complex. So I think whenever there is a Reg NMS plan, there are some characteristics of each plan. It tends to be there's an operating committee which is comprised of the SRO participants, and then there tends to be and then there are advisory committees which are non-SRO participants, people from the industry who are comprised of it. And that relationship, I think, varies depending upon which plan we're talking about, right? When you look at the limit up, limit down, which is an NMS plan, that relationship between the advisory committee and the operating committee seems pretty effective, efficient, robust. They meet on a regular basis. There's transparency into the minutes and discussions around it, and that seems to work well. The options listing, the option OLPP plan, that's like a shell of a plan. It's really not much of an operating operating advisory committee relationship there. And I think when it got down to obviously for the SIP one, this is the conflicts exist. They're pretty severe. And then the stakes are much higher. So I just think that this obviously seek to address that relationship or to correct it. And listen, we are in favor of the STA, myself personally, that the governance needs to change on it. And but I do think I'll make two statements on it. One is that I can appreciate. I know that some of the exchanges will talk about. Listen, we have multiple plans right now, and obviously we're looking. The goal here is to bring it down to one plan, and there's a lot of complexities in doing that. And I think everyone can fully appreciate the complexities of taking two plans and putting them on two systems and putting them into one. But I think that people have to understand is that the industry is living with those complexities on the other side of the trade day in and day out. So that complexity that they kind of refer to in my opinion personally, it's a one-time complexity. I get it. It's hard, but do it. All right. We try to find a way to do this, and then we can kind of move forward on it. But listen, I think that this thing, whether it lives or dies, whether it follows through, though, I think there is legitimate controversy around having non-SRO participants having a voting on an SRO plan, and I think that while I think the commission has been very creative and very thoughtful in how they design the votes, and that yes, these are non-SRO participants, and that we're going to give them some voting power here, and it will never be enough to kind of overturn whatever exchanges really want to do on it. These things have a way of looking differently through the eyes of like a judge, and I am, I think we'll have to see where this goes longer term. But listen, it needs reform. It needs reform.
Okay. No, I think that's a fair overview of where that stands. I guess on the infrastructure proposal, a lot of complexity, a lot of pages to the infrastructure proposal itself, and a lot of embedded questions that I don't know that were necessarily even able to be answered in the comment period. That's really where I was thinking, both as we look ahead to where things go with the SEC. We're coming up on an election. We are coming up on the end of Chairman Clayton's term. Kind of what are your thoughts around what might happen now with the infrastructure proposal, and kind of longer term, what do you look at Chairman Clayton's legacy as his, term comes to an end?
Well, listen, I mean, I don't. As far as the proposal itself, I mean, we're going to be talking about this for quite a while, right? So, I mean, this was a huge advancement just to get the proposal out and get the comments in. We're going to be talking about this for a long time. Okay, from what lens, kind of, yeah, that could be impacted by who the next chair is on it, from what lens and what slant on it. But yeah, I mean, to your point, listen, I know we wanted to just talk a little bit about, Jay Clayton, and his term is going to be, he will be leaving at the end of the year. So to kind of look back and think about what his legacy is going to be, or how he's performed on it, I think the industry overall feels pretty good with the work that he's done in the short time that he's been at the commission. I mean, I think when we look at chairs, there are certain things that I think we all look to, whether it's a chairman or a CEO of a firm. Are they able to attract good talent? Are they able to create a good culture? And I think he gets good grades on both of those. And I think one area where I think he kind of exceeded was his ability to kind of create real working relationships outside the SEC, in particular with Chris Giancarlo at the CFTC, and even the Justice Department more recently with the MOU that they just signed on it. But I think when we look at these chairs, I think one of the ways we kind of look at them is that whenever you get a new chairman comes in, a third of the time is spent kind of mopping up what was left from the previous administration, and then a third of the time tends to be spent on responding to whatever the event is of the day, and then the third part is what are they going to be leaving behind? What's really going to be their legacy on it? So I think he has done a very good job as far as cleaning up a lot of the stuff that just got filled, not because of his predecessor, just the clock ran out on him. He has done a really good job in some of those areas, in particular CAT. That's all I want to say on CAT is I just want to say CAT, and we'll just move on. But the responding to unforeseen, I think there are two that you can really point to. So when one is that when he was nominated in January 17, and then he assumed his office like in May. So in that 3-month window, he spent a lot of time on the Senate, on the Hill, meeting with senators who would eventually vote on his approval or not. And in the course of that 3 months, he was not asked one question on crypto. And then as soon as he put his hand on the Bible and swore, the oath, the crypto obviously reemerged and blew up. And I think that he did a very good job. I know some people, I'm not giving him an A, I'm not going to give him an F. So I don't, we don't get in grades here, but he did respond to that in a very transparent manner and very due diligence, and again working with the CFTC on it. The other area, as we just saw this morning on it, where again another controversial area is around private markets, and I think in private markets as pertains to obviously capital formation, and I do think that that he probably came into the seat. What can I do to kind of help the companies go public? And I mean, I tend to be more of a public markets person. I think most of the people on this call are as well. What can I do to help companies get public sooner, and so on? And I think as he was kind of getting into it in this environment that we're in, that the private markets obviously are just too big. Interest rates are staying this low, and I think that he did see that there is work that should be done in the private markets as well. And we do realize that this is controversial in the regard that some of the changes may keep companies staying private longer than maybe they wouldn't be. But I think his heart was in the right place here, in that capital formation, innovation and capital formation go hand in hand. Capital formation creates jobs, which obviously builds for a strong economy. But capital formation is also about generating wealth in our nation. And I do think that this is where I think he has his heart in the right spot, is that he realizes that there is a tremendous amount of capital formation going on in the private markets that mom and pop investors have no access to. And I do think that even with today's, I know they're voting on it today, but it's a definition of accredited investor is really around the idea of how can we change it from a wealth standard to more of a
knowledge.
Knowledge and experience. That's what it was. That's what knowledge and experience metric on it. So listen, I think that's probably going to be, at least in my opinion, what I'm going to look for down the road. That's what I think he's going to be leaving behind.
That's great. Mentioning wealth creation and interesting things in the news, right? So we have seen, I don't know if it's wealth creation or wealth destruction, but we've seen interesting things that have hit the news recently in the news cycle around financial transaction tax, for example. And I will say we are coming up on 45 minutes, so if you do have questions, you can enter them into the Q&A box, and we'll try to get to some of those before we end as well. But I know financial transaction tax has been an issue that we've done research on, we've published. I know STA has been out in front of as well. Like to get your thoughts. I know there was a New Jersey proposal that came up at the state level here recently. We'd love to hear your thoughts and where we might go on that.
Yeah, so listen, I mean, I think, a financial transaction tax, again, not something, this is just, something that just is always around. It's almost like we look at it like, what's the threat meter? Is it, orange, yellow, or red on it? They kind of fall into a couple of different categories. There's, FTTs at the national level that are being discussed, and there are FTTs, obviously, that you just touched on that are being discussed at the state level. And, I mean, at the state level, listen, there is states obviously reeling from budget deficits from COVID-19. We have a lot of thoughts on FTT that it would be difficult to get in the next 3 minutes here. But I mean, listen, it's a lot of some of the fallacies around it, some of the false narratives that get on it. It's not a tax on Wall Street; it's a tax on the individual, right? If I enter a trade and I enter it through a broker dealer A and it goes to exchange C. Exchange C is not paying that FTT, nor is broker dealer B. It's coming right to me because it's my trade. It's my trade. All right. So at the state level, they look at this like I'm sure their eyes get really big, like like a hanging curveball that you can hit, and then they see the money and they put in a small number, and then, oh my God, we can generate all this money. I don't know how somebody in New Jersey is going to be able to collect a tax from somebody in California buying 100 shares of Tesla on their app. Okay, so they're not, so we have legitimate concerns around this, and a lot of those concerns are just kind of based on some of these false perceived notions around it. That's going to raise a lot of money, that it's a tax on Wall Street, and that it's just this little rate that we're charging on a big number on a broad base. And
right. Well, I do think we have there's some historic precedent that show it doesn't live up to the hype, right? And we've seen it in other countries and other jurisdictions. And the fear is always that if you do tax one thing, that you'll end up incenting other types of transactions and trading that'll move it away from, again, what we find to be the most liquid and best markets in the world in the U.S. So that's always another concern. We do have a question I wanted to make sure we got to. So there was a question here around payment for order flow, and the question was, in essence, is payment for order flow any different than maker-taker rebates on exchanges, in particular in terms of disclosure, and now especially with the enhanced disclosures we see from the brokers? And what are your thoughts on that?
So they'll be more closely aligned as Rule 606b3 comes out, right? So yeah, there's a very legitimate question, right? As far as an institution gives an order to his broker to handle, and how that order gets routed and the decision making on those orders. And obviously, it's not just the first route, but sometimes it's the second route on the order is. So I do think that the level of transparency into that type of behavior is not. It will be improving and should improve to give the transparency back to the end client, to them to kind of, again, for them to be able to make an understanding. As far as understanding that there is this conflict out there in the marketplace. I need to be aware of this conflict, that I'm dealing with conflicted parties. I have choices if I don't like what I see, but I need the information in order for me to make that decision on it. So I do think there are similarities but I think where they need to get more similar is just in the transparency, and that the client has better visibility into the behavior of the conflicted parties.
Sure. At the end of the day, transparency tends to be the best disinfectant, right?
Yes.
Well, I don't see any more questions. We're at the 45-minute mark. I would like to thank Jim very much for participating today. I think the discussion's been great. Lots of good information. I'd like to thank everybody who joined us today. There will be a recording of the presentation as well. If you do have any other questions, always feel free to reach out to us at Greenwich Associates. I know Jim's always available as well. We'd like to thank you for your time today and wish everyone the best. So thank you all very much.
Thank you very much. Thanks, Shane.
Bye-bye.